Hello everyone, this is PC here from Global Alpha Search. We've just finished another month, so it's time for us to summarize the markets and our portfolio for the month of November 2021. Let me just kick off with showing you a short presentation. I will present my screen. And we'll go from there. All right, so starting out with the portfolio overview, as you might have noticed in some of our latest monthly updates, we have built up a synthetic internal benchmark for our portfolio. We do not use external benchmarks for an obvious reason that our strategy is just not really fit well for this kind of benchmark, and our philosophy does not really take into account benchmarking to external benchmarks because our equity allocations are swinging throughout the economic cycle. But anyway, for each of the cycles phases, we are able to present you a synthetic internal benchmark. And for now, as of recovery, because this is the cycle phase we are in right now, the internal benchmark consists of 70% of US equities represented by the S&P, gold, bullion with 15% weight represented by GLD ETF, and long-term treasuries represented by Tilt, which also have a weight of 15% in the portfolio. Now, each of the constituents performed, as you can see here, in November, aggregating to a total change for the synthetic internal benchmark of minus 60 basis points. Now, moving on to our portfolio, the portfolio was down 2.3%, so slightly performed slightly worse than the benchmark itself. This pretty much happened in the last day of the month, as the index dropped 2% on the 30th of November after some comments regarding the monetary policy from Fed Chair Jerome Powell, but we'll come back to that later on. Equity allocation in the portfolio right now is slightly less than 51% as far as pure equity is concerned, plus we're adding equity ETFs, some of them leveraged, some of them not. This all adds up to a total equity allocation of slightly less than 75%, which is in line with the expansion phase we are in right now. Risk of the portfolio on the average was 4. This is slightly higher than the month before when it was 3, and maximum risk was still 4. This is in line with our target as well. I'm not planning the risk to increase substantially above 4 on average basis. That might obviously be periods of higher volatility, and we might end up at the volatility of 5, but all in all, we're targeting an average volatility and risk score of between 3 to 4 for our portfolio in the long term. Top 5 holdings. A few changes here versus last month. SPXL is still the biggest holding. This is the leveraged long S&P ETF. It's my directional play to the year end, as I'm generally staying constructive on equities into the end of 2021. I also have a smaller position in TQQQ, which I have now trimmed over the month of November with a profit. Tilt is now also almost 12%. The pressure on increasing long-term yields has diminished a little bit in November, mainly due to a couple of reasons, but the biggest of them was obviously Omicron, the new COVID variant, which sparked some safe haven purchasing of long-term treasuries in general, and I have now increased the exposure to Tilt from roughly 8-9% to almost 12% at the expense of selling the VTIP, so the inflation adjusted treasuries represented by the VTIP ETF that we had in the portfolio for the last couple of months. In general, I do think that in winter, for the next, say, 3 to 5 months, we will have a wave of new informations regarding the new COVID variants, and there might be some tendency for people looking to buy into safe haven assets like the long-term treasuries. As far as gold is concerned, we're having an exposure of slightly over 10% in the portfolio, which is underweight versus the benchmark of 15%. As for the expansion phase, the exposure is built up of GLD and gold barrick. So we're having bullion, gold bullion directly in our portfolio, plus we have some exposure to gold through one of the world's biggest gold producers, namely Barrick Gold. I have added exposure into IWM, which is the Russell 2000 ETF. I basically do believe that in the latter phases of the expansion phase, the small and mid-cap names should generally outperform, and that's why I have increased and I have generally built the exposure into IWM over the month of November. So far, the trade is down, but I do plan to keep it for a longer period of time in general. So I think IWM will stay with us for some time. Alibaba still in the portfolio, although it's getting diluted as far as its weighing in the portfolio is concerned, because the price keeps dropping. The mood around Chinese companies is still really bad. We had a nice rebound in October, if I'm not mistaken, but nothing is really left out of this rebound, and most of those Chinese blue chips are trading at their multi-month lows, including Alibaba. I still do believe that in the long term it's a good holding, and I do keep exposure to Alibaba, although I do not plan increasing the portfolio weight to China, given the fact that there seem to be some structural changes going on over there in regards to how the markets will generally be pricing Chinese assets, given the uncertainty around the regulations and so on and so forth. The major reshuffles in the portfolio over the month of November were two things, basically. So first one, crypto, and second one, Europe. I visited Web Summit 2021 at the start of November, and it was a really eye-opening visit for me. It was the biggest startup conference around the world by far, and I have had many very fruitful conversations in regards to the blockchain and crypto space in general. I do believe that in the long run, blockchain and some of the cryptos, not all of them obviously, because there's also many spaces where there are huge bubbles in the crypto space, but some of the cryptos do have a chance to revolutionize the financial markets and the payments as we know now. The exposure will most possibly not exceed 5% of the portfolio in the long term, and it's mostly concentrated around two major ideas, which is the proof of stake, the new protocol for cryptos that is developing quite strongly right now, and the DeFi, so the decentralized finance story. These are the cryptos I want to concentrate my exposure around going forward, mainly Ethereum, Solana, Ada Cardano, Mana, which is the decentralized cryptocurrency, sorry, and the NG. So that's one thing that was added to the portfolio in November, and the second thing was basically the exposure to Europe. I will explain why Europe later in one of the later slides of this presentation, but I want to start out with basically stating that we do increase exposure to European equities in general. In November, we have added Porsche, Logitech, and Norsk Hydro as far as the European equities are concerned. Moving forward, major drivers for November that I have managed to observe were the following. I will explain them in details in the following slides. Tapering, that's what we knew that it's going to start in November, and it did start. I mean, tapering in US, of course. Inflation, which still keeps surprising to the upside, and it's still one of the biggest problems for most of the equity markets. Strong third quarter reporting season, which confirms generally that the equity story is very positive. And fourth quarter seasonal issues, which were doing their work up until the middle of November. S&P was even up 5% for the fourth quarter, but gave away half of the gains already in the last couple of days of November due to the uprise of Omicron, the new virus variant, and also in the last day of November, we had those comments from Mr. Powell regarding a potentially more hawkish monetary policy, and all that sparked additional volatility to the downside. So on a net basis, in the fourth quarter, markets are up only 2.5% as far as the S&P is concerned. Yeah, November finished at the lows, which is not ideal. Everybody was expecting a nice rally into the year end, but end of November took people mostly by surprise. We'll have to watch the markets in December to see how they digest the Omicron issue and the potentially more hawkish monetary policy issue. Tapering, a few words on that. As you possibly know, in October and at the start of November, it was announced that later this month, the policy making institution, which is the FOMC, will start the reductions of its 120 billion monthly asset purchases program. The current pace of the reduction was planned to be 15 billion each month, out of which 10 billion was supposed to be treasuries and 5 billion mortgage-backed security. As you see here in the lower left corner on the graph, this is basically the Fed assets, total assets of the Federal Reserve so far this year. As you can see, they have been growing quite stable in a stable manner. Going forward, given the fact that asset purchases will be lower and lower, one should expect the dynamics to be slowing in general. It can be even better seen here on the lower right side of the screen, as this chart is showing the year-on-year changes in asset purchases. They have increased substantially throughout the recession we've had last year. They have been on a very high elevated level of over 80% year-on-year change, basically throughout the second half of 2020 up until March 2021, and then they started falling, being stable for the last couple of months. But going forward, one should expect a falling dynamic of the year-on-year changes in the asset purchases in general. Continuing the tapering, this is the news we got just a couple of days ago, pretty much on the 30th of November, from Mr. Powell. He was having an appearance before the Senate committee, and he stated that at this point the economy is very strong and inflationary pressures are higher, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases. I expect that we will discuss that at our upcoming meeting. So he basically suggested that the Fed is thinking about fighting the inflation pressures more dynamically, which basically took markets by surprise, and that's the reason why the markets were down 2-3% over the last couple of days. Plus, obviously, the Omicron did not help as well. So this is something new that the market has to digest. the first sign pretty much of the Fed going ahead of the market's expectations as far as the monetary policy is concerned. So I think it's a pretty clear sign that the Fed has basically switched from an attitude where they want to keep inflation running above their targets and they're fine with it, to a situation where they want to start actively fighting inflation. So we are basically seeing a more hawkish Fed, which is obviously not ideal. We should expect potentially quicker tapering and maybe even a sooner interest rate increases, which for now are basically planned for let's say second half of 2022. But obviously going forward, the expectations change accordingly to how the inflationary readings are going to look like. And talking about inflation, it's one of the second issues we have basically seen throughout November. You can see here a table of the inflation rate, year-on-year inflation rate for the top 10 countries in the world. And it's a heat map basically, right? So it shows you the metrics of where there is a problem or not, meaning where a certain metric is running above consensus expectations or below consensus expectations. In case of inflation rate, you see here in all the top 10 world's economies, there's an issue maybe with an exception of Japan, but all the other ones are basically facing an issue with inflation running above the expectations and mostly above the specific central bank's targets. In case of US, you can see here, and then for the last 2 consecutive months, we've had positive inflation surprises. In October, it was 5.4%. In September, it was 5.4% versus 5.3% expected. And in October, the surprise was even higher, 6.2% versus 5.4%. And it's pretty much the same issue in the EU, 4.1 versus 3.4 for October, and November reading also certainly way above the expectations, 4.9 versus 4.1. So inflation is still an issue, and no wonder the Fed is starting to be more hawkish, to expect that if inflation pressures do not subside from here, we might even see the Fed going out more hawkish than it did right now at the end of November. Now moving on to more micro space, the third quarter reporting season was good again. As you see here, most of the companies have reported already. The average sales surprise was a positive surprise of 2.6%, and an average earnings surprise was almost 10%, 9.2%. Biggest surprises came from the energy sector, both on the sales side and on the EPS side. That mainly had to do with the increase of energy prices, of course. On top of that, we saw financials doing quite well, especially on the earnings surprise basis. That obviously had to do with higher interest rates, which are a positive for the financial sector. Here you can see a setup of the recent quarters and the surprises. As you hear, the tendency is basically decreasing, right? So it's tougher and tougher for the companies to be showing positive surprises, but still there are on a net basis positive surprises shown in the third quarter of 2021, which on general is a positive for equities going forward. Valuations right now are, at least for the S&P, are not that challenging. It looks a little bit differently for the Nasdaq, obviously, but I'll come to that later. The average EPS for end of 2021 expected by the Bloomberg consensus is $225, which is a growth of slightly less than 5%. On a year-on-year basis. So the EPS is expected to be growing, which is obviously supportive for equities. I would like to stick your attention to a few other things. Basically, the dividend yield. Right now, next year's dividend yield for the S&P is 145%, which is exactly matching the current level of 10-year Treasury yield. So we can say that on general equities and on a balanced level versus on a balanced relative level versus long-term treasuries. Once we had a big surge in the long-term treasury yields, the equities started to underperform naturally. But right now it changed a little bit. So let's say from a perspective of an investor that would look at buying either into equities or long-term bonds, it's basically a 50-50 choice at this point of time. Price to book, relatively challenging, above 4. EBITDA on an aggregate basis right now is not really anything that would stick out versus historical standards. Yeah, I think in general S&P is not really trading at very high valuations, obviously on a relative basis to some other indices and equities. But versus the historical standards, we are still trading above average, which is between like 16 to 18 times for the S&P. Forecasts and expectations on the macro front, nothing changed versus last month. So our macro model is still expecting and forecasting the expansion period to last until December of this year, and then we should switch to the boom phase starting from January 2022, which obviously has some natural consequences. In general, I do think that for 2022, sorry, the attitude towards equities should be a little bit more cautious. There's still a lot of discussion on whether we are basically seeing the economy entering the boom phase, or maybe we are just facing a new general paradigm of a higher CPI, which is persistently going to stay above the short-term unemployment rate, which includes or implies, sorry, a positive enhanced spread, which has not been usually the case throughout expansion phase in the history. So this is new in the model. Most of the signs are showing that basically we will just have to get used to it. But still, as the readings show and as we read them, we are entering the boom phase as of now. So a little bit lower exposure to equities and a little bit more cautiousness in regards to picking levels of entering equities should be definitely suggested. The yield curve is still steep, but has flattened somewhat in November, especially in the last week of November on the sell-off that we had, but it still does not confirm a boom just yet. We will definitely need to see a further flattening of the yield curve to be looking for a potential cycle peak. The Fed still does not really still feel extremely hawkish, but it's getting more hawkish than everybody expects, which is also important. On an aggregate basis, the Fed attitude is still very accommodative. Omicron plus the recent comments from Mr. Powell have sparked some safe haven buying into the month end. So it did kind of flatten the yield curve a little bit, but that's just a short-term phenomenon for now. One should not really judge purely on that, and we should continue to watch the yield curve over the next couple of months. Conditions might be getting tougher. I already said that, so nothing more to add here really. On the micro front, the forecast expectations would look as follow in my view. In the blue chip space, the valuations are still attractive. The S&P trades on a 21 to 22 times PE for next year. The technology stocks valuations are obviously much more stretched at around 31 times right now for next year. As far as the dividend yield is concerned, at this point of time, it's only the Dow Jones industrial average that has a higher dividend yield versus the 10-year treasuries. The S&P is kind of equal to the yield for treasuries right now, and obviously the tech indices do not deliver the appropriate dividend yield that everyone would expect it to see and be competitive to the long-term treasuries yield as of now. Judging by the 2 points above, one can assume that with general expectations of higher interest rates next year and Fed raising rates, potentially the value stocks should being attractively priced should generally be a safer play than growth stocks. This is a general view. Most of the market analysts, and I do kind of tend to agree with that. I do see a growing schism of predictions for 2022, and most of the securities houses are not really that they do not kind of agree, on where they do see equities for next year. I have written a post on this. If you want to look into details, you can see it here. You can definitely find it on my feed. It was called "What's in Store for Equities in 2022." Just summarizing it shortly, there's a growing schism of predictions. I do see a couple of houses showing a market being down for next year. For instance, Morgan Stanley having a target of 4,400 for the S&P for the end of 2022, and on the other hand, we see Goldman and JP Morgan, which are still pretty bullish, seeing the S&P above 5,000. The most reasonable prediction of mine looks basically like this. On the basis of the data aggregated by Yardeni Research, not Bloomberg this time to be exact, but Yardeni Research, which I highly value, they see a consensus EPS estimate for 2022 at $222 and an average next 12-month forward PE of slightly above 22, which basically implies an S&P target of slightly less than 5,000. It's 4,966.5 to be exact. So I would see the S&P for next year within the range of, let's say, 4,750 based on the Bloomberg consensus, and let's say 5,000 based on the consensus collected by Yardeni Research. Assuming no recession in 2022 and no general repricing of equities, there is still upside. That's the general conclusion. Now coming back to Europe, the point that I have mentioned at the start of my presentation, why I do increase exposure to some of the European equities is basically a couple of reasons. First, I do think there is going to be a further divergence of the monetary policies between US and EU. The US is getting hawkish already, whilst EU will stay pretty dovish, most possibly throughout 2022, which implies a weaker euro against the dollar, and this naturally gives better growth potential to the European exporters, especially the industrial companies plus the car makers, right? We're also seeing an improving Chinese PMIs lately, and Europe is quite well exposed to that. So in general, I do think that getting a little bit more exposure to Europe makes sense for 2022. That's it for now, guys. Thank you very much. Should you consider following or copying me, please take into account that I do strongly advise you to be patient and treat our portfolio as a long-term portfolio There's obviously turbulences throughout the year each time, so do stay resilient through them, and do treat your investments as long-term investments. This is the best way to ensure long-term gains. Thank you very much. This will be it for today, and I'll hear you in a month. Thank you.